to TradeSpoon. My name is Vlad Karpel. I'm CEO and founder of TradeSpoon, and today we're going to have a live trading room open to trade stock and options using TradeSpoon and Yellow Tunnel technologies. Welcome everybody on Discord. For those of you who are new, welcome. If this is your first live event, do me a favor, type in first. Also want to welcome new subscribers. Disclosures are very important. Trading stock and options involve risk, not suitable for everyone. You must be aware of the risk and be willing to accept it in order to invest in current market conditions. I'm not a financial advisor. I'm not registered with FINRA nor SEC. I'm showing you what I do in my own account based on my own risk tolerance level for general education information purposes only. Trading plan. Portfolio allocation. You propose to have 30% of your portfolio in cash. Market is volatile. I would probably bump it up to 50% on average. And then the most important decision is portfolio drawdown, right? It's looking at the, how many positions do we have? 4 positions. I propose to have 4 positions, maximum loss of 2.5% of account value. How do you calculate 2.5% of account value? That is the most difficult decision. I propose to, if you're a short-term aggressive day trader, right, you can see market is fluctuating between 417 and 407, right? So if you're aggressive short-term trader, you're day trader, I would put 407 is your stop loss to calculate. If you hold in position, so if you hold in position for a couple of days, right, then 407 is your stop loss. So if you're buying at 413, you know, $5 is your stop loss. And 2.5% would be of $10,000 portfolio would be $250. So $250, it means you can buy 50 shares. I would break it down into 2 halves, 25 shares now and 25 shares once it reaches 408, because you see more often than not the support line holds, right? If you hold in position for more than a couple of days, let's say 2 to 3 weeks, you look at the previous low, right? If you hold it for 2 weeks, your low is 398. That could be a good support, right? Then calculation would be you're risking $15. So $250, you can only buy 20 shares, right? So then I would buy 10 shares now and 10 shares close to 401 level, right? If you hold in position for more than 2 weeks, you know, the low is 380, right? 380, that would be 35 points. 35 points, $250, then you can only buy 8 shares. Then same thing, you would buy 4 shares here and 4 shares, 391. So you have to be tactical, right? You have to be proactive. You have to decide how long you hold in position and what is your stop level, which is very difficult for most, especially new traders, right? They don't think about stop loss. They're avoiding negative feelings. I would suggest that, again, you know, if you don't think about stop losses, you don't have a timeline, the strategy would be selling to the rallies, right? You short at 413, you raise cash. If it reaches 430, you raise cash. And if it reaches 450, you continue to raise cash, right? If you don't think about stop losses. Because market is volatile, you know, it can be at 380, right? We have ECB decision tomorrow, which will probably spark the volatility. We have CPI data Friday, probably will spark volatility to the upside or to the downside. So if you're not tactical short-term trader with very disciplined stop losses, I would be a seller into the rallies, right? You sell at 413, you sell at 430, 440, because the idea is that this downtrend probably will not be broken, right? We're trading in the bear market, right? And this is just a rally in the bear market. If you are a disciplined trader, you know how to determine your stop loss. You went through that calculations that I just described. And you always do it, you keep a journal, you write it down, then you could be tactical. I think there's more room to the upside short term for the next, you know, couple weeks, maybe even couple months. We'll see based on the earnings season. But, you know, best case, you know, probably either end of June or middle of July, this rally will probably tap out. But, you know, in order to go long in this market, I would be, you know, I would have to put well-defined stop levels. I'm actually part of this EO organization. We had a pretty good discussion, which I actually thought would be useful to spend here. So again, you know, one of my favorite books for trading, even though it's not trading, is Annie Duke, Thinking in Bets. She has a chapter on Ulysses strategy. So I was trying to find something more. I mean, I actually just went to Greece. It's beautiful. But I'm not sure if you heard it, but Ulysses strategy, right? It's going, back to Greek mythology, story of Ulysses and the Sirens, right? In the Odyssey, great adventure, Odyssey spends 10 years trying to get home safely from the Trojan War. Near the beginning of his journey, he sails past the island of the Sirens, who sing, sweetly sailors songs, right? And die listening to the music, right? So Odysseus wants to hear the songs, but he also wants to make it home. So he plugs the ears of his sailors with wax and has them bind him to the mast of their ship, right? As they sail past, he begs his men to set him free. Let me see. But they follow his previous instruction and bind him harder till the beckoning process. So emotions are the siren songs for people worried about retirement, right? Prospect theory is behavioral model developed by Nobel Prize winner Amos Tversky and Daniel Kahneman, a very famous psychologist. It provides that people very often make irrational decisions when faced with choices that involve risk, reward, and uncertainty. Economists and financial planners now more easily recognize that people make predictable mistakes when faced with hard money choices. Fear, common example of prospect theory, right? In action is a panic selling in the falling stock market. You might have seen this behavior this year. And greed, and it works the other way around too. When markets and home prices are going up, people are likely to make bad decisions and take on too much risk. Ulysses strategy, 5 ways to control your emotions, to keep a steady course toward your goals. Emotions, for better or worse, are windows through which we see the world. There is no way to get rid of them, and if you did, your life would be pretty gray. But using the Ulysses strategy, you can tie yourself to the mast, tame the powers of your emotions to get the positive outcome you want and avoid negative consequences for your nest egg. And this is kind of, I made this references very often, the idea of fear of future regret, right? And there was actually interesting discussion, not in this article, but just in general, and Annie Duke was talking about. So you use regret, fear are the most two powerful emotions that humans experience. The point is that usually regret, according to Nietzsche, we push forward, right? There's no reason to use the regret in front of your decision. But what this book talks about is sometimes we can use regret into our advantage, right? We can push the regret in the front of our decision, right? This idea of fear of future regret, get tied to the mast, right? We can tie ourselves to the mast, right? What do? We go through this future rehearsal exercises. We know that if we listen to the songs of sirens, it will cause, negative consequences, right? So how do you tie it to the mast? The way I interpret this, you push the regret in front of your decision, right? That's the Ulysses strategy. You push it in front of your decision-making process, and then you determine, right? You basically say, how will I feel, if the market breaks through 380, right? I'm long, let's say I'm long right now. I think market is gonna go higher, I'm long. So then how will I feel if the market drops below 380, right? I'm pushing the regret into before I make a decision, before I enter the trade, right? I tie myself to the mast. How do I do that? I basically go through that calculation, right? I know that, let's say if I can only, let's say my stop loss is 380 and 33 points, $250, right? Let's just go slowly. Right, if I buy here and I put my stop loss here, I'm risking $30, right? 30-point move. And I know that I cannot risk more than $250. That's my rule, right? That's my rule. Any single trade, I don't want to risk more than $250. So that means I can buy, let's say, 10 shares. right? So if this is how I tied myself to the mass, 10 shares, and I would just buy 5 here shares and 5 here, right? So this is my example, because I know that if I listen to the sirens, right, and I think that the market is gonna go higher, let's say I buy, 30 shares, right? I buy 30 shares, right? Because I think it's gonna go higher. I know in the future, let's say I do, I'm gonna wait for 380, I'm gonna wait for 2 to 3 days to make sure it's lower. It might actually drop to 375. And now all of a sudden I'm down $1,000, right? And initially I planned $250, and I'm gonna lose $1,000. So I know basically I was listening to the sirens, right? I was a Ulysses. I was listening, one of the crew, I was listening to the sirens. I bought 30 shares, and then at some point, I know market will break 380. So as long as I'm going to continue to listen to the sirens, I know the ship is going to get wrecked, right? It might not happen today, it might not happen tomorrow, but sometime in the future it will. So that is this is an example. So now I'm down $1,000, right? So I'm pushing regret, right? And this is the way she said this, I was never thinking about this, but. And this is actually Nietzsche was talking about this. You push regret before you make a decision, right? Before you make a decision. And this is a very powerful concept in psychology, right? You push it before you make a decision, not after, because after, this is a very powerful emotion that most of us, want to avoid. But if you push the regret forward, before you make a decision, you can use it to your advantage, right? You can use it to your advantage, and it's a very common concept in psychology. And there's actually a term, Ulysses strategy, right? It's not just a story of Ulysses; it's actually a term that psychologists use all the time. Maintain retirement plan, this is just general concept. Create, following a strict plan for investment, right? Don't break your rules. Hire a trusted crew, right? You hired Yellow Tunnel, right? You believe them, you trust them. Alex, welcome. CP, welcome to the live stream. Do me a favor, guys. If you guys can hear me, just type in stream chat hello, or in stream chat hello, and just say hi on the Discord. I assume you guys can hear me and see me. Alex, CP, welcome. So hire a trusted crew, that can help you. We'll say Yellow Tunnel and Tradespoon in this example. Take calculated and rational risk, and think in small bets, right? That don't think in absolute terms. Don't think all in. Just because you dealt 2 aces, that doesn't mean you should go all in, right? Just because it's not 100% certainty you're going to win that hand. Same thing. Just because Vlad said market is going to break through this 420 most likely, that doesn't mean it's going to happen, right? You want to put a well-defined investment with rational risk and calculated risk, right? Very important. Sit with your emotions, right? Before you take any big financial action, sit with your emotions. Ulysses understood what he was feeling and created a plan of action for dealing with his emotion, right? Trading plan, keep a journal, write a plan of investing or trading before the market opens. As Franklin Roosevelt famously said, the only thing we have to fear is fear itself, nameless, unreasoning, unjustified terror, which paralyzes needed effort to convert retreat into advance. Break down the nameless, unreasoning fear. Alex, thank you. Perfect. Thank you. Break down the, and I assume you can see me, right, Alex? I assume you can see me. Break down the nameless. Perfect. Thanks a lot. Great. Break down the nameless, unreasoning fear into its different components. What exactly are you afraid of? Is it a problem that can be addressed today? Or right? So we're all different. We're all wired differently. My fear is of future regret. I paint different pictures than that you guys do. So but that's, everybody's a little bit different. But we all humans, and we all these are our triggers. Before you pull a trigger on a large potentially damaging decision like liquidating your investment portfolio, taking loan against your 401k, take these 3 steps to slow down your thinking and eliminate choice based on panic, right? Name the emotion, right? Put a name into the emotion, write it down, keep a journal, it will slow down. feel it. Once you have broken down the components of your feeling to something nameable, allow yourself to, if the space feels those emotions. Rationalization is this process of denying your emotions. Working through your emotions meaning acknowledge their sources so you can plan, right? Emotions are good, right? We need emotions, right? You know, we shouldn't hide away from our emotions. We shouldn't deny our emotions. You know, we should work through our emotions and, you know, take positive actions. Listen to the siren songs with never awareness of consequence, right? You turn on CNBC and people say, well, buy Amazon, buy Google, buy Microsoft, they're historical lows. These are the siren songs, right? You know, you're listening to money managers, they're never gonna go short, right? They always go long, but these are your siren songs, right? So I'm not saying, you know, don't listen to them, but just awareness of consequences. Listen to the siren songs with the base, you know, it's not realistic that you turn off your TV, close all apps on your phone, stuff your ears with wax for the rest of your life, right? You know, obviously you can't tie yourself to the mess because otherwise you'll never trade. So that's the balance. All right. I don't know if you guys, so I mean, I like that presentation. I like the article. You know, obviously I think if you never read these guys, you know, emotional intelligence, you know, very powerful psychologists, you know, really good read, Thinking in Bets. All right, so hopefully that was helpful. Meanwhile, you know, QQQ, so let's see, it's meanwhile, any questions on Ulysses contract and divergence, Sunil? All right, Sunil, thank you. Good morning, Sunil. Osama, thank you. Sure. Global economy, the World Bank released a green forecast for global economy. Yes. Fear of recession, prolonged recession. Thank you, Osama, for sharing. I put forward on follow through. Okay, thank you, Bob. John, thank you. Paste the link, sure. Ulysses, or Thinking in Small, but I'll post both. Send it to all. Ted, thank you, Ted. I appreciate it. John from California, European trader again. You were John. All right, welcome, John. John back. Okay, thank you for your kind words. All right, now back to reality. My wife doesn't believe in psychology. She says it's all mumbo jumbo, you know. She says, you know, some other terms I'm not going to repeat, but okay. Some people like this, and like me, and some people don't like this, like my wife. So I'm sure we'll have half and half, but you know, nonetheless, you know, since I'm doing the presentation, I have a choice. But anyway, all right. So let's go back to, this was more of a, trading psychology is important. I believe that's half of the success. You know, if you can't deal with your emotions and you don't know how to, you know, differentiate between, you know, your, you know, the voice of sirens, right? You know, then you're gonna have a shipwreck, right? And you have a lot of these stories, right? Even like the best quantitative hedge funds went bankrupt. They still do. You hear it almost now on, you know, on a regular basis. Why? Because there's no trading psychology, right? Because they think, you know, they think that trading is a chess, right? There's a certain number of moves and permutation that will always lead to a successful outcome. And trading is not a chess, right? Trading is more like poker, right? It's a combination of science, statistics, but also luck, you know, and art. So, okay. Meanwhile, spiders is trading in the range, right? Healthy consolidation, double bottom, right? That part has not changed. Double bottom. Oops, let's see, go back here. Double bottom, neckline, pullback, kind of a classical chart, right? How long does this, how often this chart holds true? Again, don't think about absolute terms. I would say 70% of the time this chart holds, right? Continuation chart, right? This is a classical continuation chart. You go through consolidation forward. Is forward 100% of the time? No. Is it 70% of the time? Yes, right? So out of 3 trades, 2 will be successful and 1 it will, pull back and maybe even retest 394, 380. I don't think that's the case, but obviously, I push the regret forward, and I don't want to be in a situation where I put all of my money and find myself lose more than 10%. That would be unacceptable. So we have 2 events, right? ECB decision, right? Right, carry trade. That ECB, anything that affects interest rates, those are the most important decisions, right? Even Target announced, record inventory. Any bad decision, the market pulls back a little, right? And it doesn't retest the lows, right? Where in the past, 6 months, any negative decision, and we have 4% move down. So that's positive. But then you have ECB decision tomorrow, CPI data Friday. It's all about interest rates, right? And I'm a little bit concerned about the interest rates, right? So this is the risk to this rally, right? We are at 3%. Potentially, depending on what, if ECB says again that, we have the super inflation, but we're not ready to raise interest rates, then the dollar can rally and interest rates in the United States can spike. Right, so that's the risk. Right, Europe is probably acting irrationally. Right, they are, behind the ball. There are just as much inflation in Europe, or even more in Europe. Probably, I would say more in Europe than in the United States. But nonetheless, they are less aggressive in raising interest rate. If that narrative stays, that irrational behavior can last longer than your bank account. Right, that's the famous saying. Then you can, those are unpredictable events. I don't know what exactly they're going to say. I'm going to assume they're going to say that we need to raise interest rate. They might be less aggressive. And then same CPI. Everybody expects maybe year-over-year kind of drop in CPI or easing like PCE data. But again, there could be a surprise. So this is where I would push the regret forward. That you're about to swim, where there might be sirens, right? There might be sirens. So how do you plug your ears? One way to do it is, I would just go through this exercise. Let's say, market does pull back tomorrow and breaks through the support level. Go over your stop losses, go over the number of positions, right? You don't want to have more than 4 positions. You don't want to risk more than 2.5%, right? That's what I propose. 10%. Because 10%, will I be happy? Probably not, right? But that's okay, right? 10%. I know anything above 20%, I don't think rationally, right? None of those things I'm going to do in this article. But if I'm down 10%, I'm going to do a lot of things that this article, explains. So that's ECB decision. Meanwhile, interest rates. I mean, it hasn't tested 3.2 10-year yield, but it's some kind of in this mode. There's always a risk that interest rates will jump to 3.5, right? If they jump to 3.5, technology will drop, right? How much it will drop, we'll see, but that's the risk. But for now, it's kind of, we have 2 events, Thursday and Friday, that we need to get ready for. Dollar also consolidation, pulling back. That's also positive for the market. But again, that carry trade with Europe can happen, and the dollar all of a sudden can jump to 107. That would be bearish for the market. If it jumps to 104, I guess it's okay. But if it jumps to 106, 107, market is going to sell off. So those are the risks that you have in the market in the next couple of days. And then, obviously credit issues, liquidity issues. We see not Marquetta, but a firm is in the news, right? Again, they're having a hard time getting loans, or, if they do get loans, they get much higher interest rates. So that's another negative narrative in the market. High yield, it did pull back probably close to 50%, but stable. So that's positive. VIX is at 24, right? Continues to go lower. What else is interesting? Technology turned positive. Spiders slightly negative. Let me know if you have any questions. Give me 1 second. Looks like small cap continues to make incremental highs, right? And it's trading below February low and January low. So I think that's a win for the bulls, right? So small cap, kind of a broad base rally in small caps. That's positive. Let's see, gold miners pulled back, silver pulled back, metals and miners pulled back, XOP, so XLK is outperforming, and oil is at 120. So let's see, Google outperforming, right? Made new highs yesterday too. So not yesterday, 2 days ago. So continues to trade higher. That's outperforming. That's good. Microsoft slightly positive. Apple also outperforming, and let's see, Tesla higher. All right, so that's good. All right, so any questions on Discord? Alex, CP, let me know if you guys have any questions. All right, John, thank you. Mario, what is my wife's profession? She is a lawyer. She's an attorney. John agrees with her, actually. Thank you, Victor. Thank you, John. Or in chasing. Do I think there's more fear of missing out, not closing a losing trade, or in chasing stock? I know negative emotions statistically are 7 times stronger than positive. So chasing a stock market might give you a thrill, right? And might give you some positive emotions. But when the trade goes against you, that fear that is 7 times stronger, right? When you keep a journal, they actually, you know, Dr. Maneker proposed that don't spend too much time on the losing trade. Spend, you know, you need to have 7 successful trades, and you should document 7 successful trades. And you should put all your trades in the journal. You should grade yourself, right? And you should put positive comments when you made a good decision and trade went in your favor. Because otherwise, we tend to dwell on negative, right? You only document your negative trades, right? You give yourself C's and D's. You don't give yourself A and B's, and then you have a perception that, you know, it can impact your confidence as a trader. Because statistically, you need to document 7 good trades to have the same emotions than documenting 1 negative trade. So I encourage you to always document your positive trades. You know, give yourself a pat on the back, how well you did, how you made everything correct in terms of size, in terms of direction, in terms of strike prices you picked, expiration months you picked, the strategy you picked. Don't be shy and just put a lot of positive comments. And when you got C or D, yes, document what you did wrong. Don't dwell on it, and just try to learn on that mistake and move on forward. CrowdStrike. Yeah, CrowdStrike had a good earnings. It's obviously outperforming the market right now. It's going to follow QQQ. right? So my opinion, CrowdStrike, QQQ, I mean, it's outperforming now because it had strong earnings and it's been down, you know, QQQ was down 30%. How much CrowdStrike was down? 60%, 55%. So obviously it has higher beta, you know, it's up 2%, QQQ is up, you know, 0.5%, but it's not going to last too long, right? You know, whether you trade in CrowdStrike or QQQ, I think it's just the same thing. So my opinion on CrowdStrike is the same in QQQ. Right now, there is a little bit above, you know, momentum. You know, you always have some risks in trading, risk and rewards trading individual stocks, right? It's down 60%. It's in security business. It had better than expected earnings. Let's assume that. So there's a little bit higher momentum. But again, just if you long QQQ and you long CrowdStrike, just remember it's a one position. It's almost like a one position. So if you're risking 2.5% on QQQ and you're risking 2.5% on CrowdStrike, you're risking 5%, right? They're very highly correlated trades. Any earnings, Vlad? John, 5, I was thinking about this and I'm probably going to pass. And the reason I want to pass, sorry, on 5, first of all, it's in retail, right? And I'm just, you know, I don't follow 5, you know, I do like to trade at earnings, but my concern was that volume, very low volume, very low market cap, right? Pretty high price to earnings ratio, right? So I just don't feel comfortable trading, you know, low cap stocks with low volume and, you know, illiquid and, you know, not a little bit in that spread, even in my personal account, because I'm less strict with my personal account than I'm with my, you know, TradeSpoon account, because obviously people follow me on TradeSpoon, you know, so I have to be a lot more selective, right? Going back to Warren Buffett, I don't have that many shots, you know, I have to be very selective. But even in my personal account, I decided not to do it. So for now, no earnings. One thing I did do, going back to the CrowdStrike, right? Again, if you want to do earnings, this is, you know, just like you can do it before, you can do post earnings with the assumption that, you know, CrowdStrike had earnings, that risk is out, you know, it looks like it's outperforming QQQ, so you can sell a put spread. You can sell a put spread on CrowdStrike, you can call it an earnings trade, or you can sell it, you know, I have QQQ put spread on QQQ, right? They're both kind of a time decaying strategies, right? So if you want to sell a put spread on CrowdStrike, kind of call it post earnings strategy, with the assumption that there's still a lot of premium in those puts, and, you know, and VIX is slowly drifting to the downside, right? Slowly drifting to the downside, you know, then that's a good strategy. But again, size is extremely important, because again, if CPI and ECB decision is negative tomorrow, then you can have a pretty sharp pullback in the next couple of days. That QQQ, so let's go over the positions. Let's maybe even put it. So QQQ trade, the question is, why did I put it on QQQ trade yesterday? You know, again, small trade, right? I bought it 305.6. What's the QQQ trading? It's at 310. It's up 1.5%. It's facing a lot of overhead resistance, right? So I can actually close that trade now. Not the entire trade, but I'm trading around this position. And what do I see in this position? So I'm gonna close. 310, let's say 57. All right, so what do I see in this trade? Why do I make this trade? Because I see that if you do short-term trade, right? We have different traders, right? We have short-term traders, long-term traders, you know. if you're an aggressive short-term trader, you basically say to yourself, kind of day trader. If you're a day trader, or maybe you hold a position 1 or 2 days, you can see since May 27th, right, for the past almost 2 weeks, market is trading in this well-defined box, rectangle, however you want to call this, right? So we've touched this support level multiple times, right? Going back to actually May, right, in terms of overhead resistance, what's now a support. So the theory is that if you're a short-term aggressive trader, you sell every time it reaches or gets close to 316 or 312, right? Or you buy at 3 or 4 with a very tight, well-defined stop level, right? Because if this level is breached, right, if this gap is closed for 1 or 2 days and trades below this, most likely we're going lower, right? So you buy here and you sell here, and you're doing these short-term trades. It's only geared to someone who's willing to take that extra risk and likes short-term trading, right? We're talking about 1 or 2 days. So then, you're trying to capture, usually I try to capture 0.5% on these trades. Obviously, market is more volatile. So in this example, I captured 1.5%. But you do this trade multiple times because you basically don't know how long we can trade in this box, right? We can, tomorrow we can get out of this box, right? At some point this market will exit this box. But is that going to happen tomorrow, on Thursday after the ECB decision? Will it happen after CPI data? On Friday, will it happen after PPI data? On Monday, I don't know. But I do know at some point it's either going to do this, right? Those are my 2 choices, right? 2 choices. It's either going to break below and maybe retest the lows, or it's going to break above and retest, May high. So, I personally think it's going to be this. I put 70% confidence on this, but I do realize, that there's a 30% chance that, or 30% confidence that, it will do this, right? So you invest based on your opinion. The only thing I have to decide is, how much money am I willing to risk, right? It has to be well-defined risk. It has to be small investment, because we're going to have a lot of these boxes in the next 12 months, right? This is not the first box, not the last box. It's going to happen. So that's the reason I was buying close to here, and this is the reason I'm selling close to here, because tomorrow market is going to move. Market is going to move. So I still have QQQ. I didn't close the entire position because I still think this, but maybe it makes sense to trim your positions in case, we pull back either to 300 or, or 290. So that's the QQQ trade. Thank you, Pat, for the question. John, thank you. Fred, thank you. Alibaba is going crazy. Alibaba is going crazy. Yes, I think this is one of the good trades, FXI, right, or KWeb. You either trade FXI if you are, or you trade KWeb. I think there's more room to the upside, and probably will outperform the spiders. So if you want like individual names, Alibaba. If you don't want to take an individual name risk, KWeb or FXI is definitely has a lot. It's broke this downtrend, right? Trading above this downtrend, and as this whole reopening of the Chinese economy, be less hawkish on regulating the companies and now stimulating the economy. It's a good theme, right? So you'll probably get at least to 36 or 38. I mean, is the bear market over in China? Probably not, but can it continue for the next couple of weeks? Yes, there is a good chance. Thank you. Oh, Pat, how do I get the nice entry? I don't know. You try to do it in the live trading room, right? So, I mean, you watch these levels and you're trading around 305. I think we did this yesterday in the morning, right? It pulled back. So kind of, you can see it rallied, pulled back. So usually this is a good support, 305, 306. So, Pat, thank you. I'm different than most analysts. John, Fed report, yes, Jerry, Fed report. Thank you. I am, well, again, going back to game theory, most analysts that you hear on the, on the news, they don't manage their own money, right? I'm here to manage my own money, share my experience with subscribers to Tradespoon and Yellow Tunnel. So that's my perspective. The more you guys watch the videos and the more successful the Tradespoon Yellow Tunnel community, the longer you're gonna stay, right? I don't know who you are and I don't know how much money you're managing. As long as I give you a valid, sound advice, I assume you guys gonna make money and continue to stay. Most advices you hear on the news are money managers. Money managers cannot invest their own money. Most of the time they invest other people's money, right? And it's a totally different psychology, totally different mindset, completely different. We're different here because we are managing our own money. When you listen on the news, 9 out of 10 people who come out on the news, they're managing other people's money. They cannot say, well, we are in a bear market. And even if they do, they're concerned that there's, followers or gonna, go into cash, right? If you guys tell me I want to be 80% cash, I'm never going to tell you no, right? I think it's maybe a great idea. But you ask any money managers out there, they're not going to tell you, well, don't, it's crazy, never going to time the market. You lost some, you would lose so much money in the past 50, they'll talk you out because we have all different psychology, right? Different goals. So it's always something to keep in mind when you going back to this Ulysses, try to understand whoever you're listening to, what their background is, how they make money, and what is their, how they make money. I guess that's the best line, right? How do they make money, right? What's their background? How do they make money? And that gives, they will have a bias, right? We all have biases. So important to keep that in mind. Fed report, yes. June 10th is going to be an issue. John, trading view, I do like trading view. Thank you. JD looks good too. Thank you. Yes. So I mean, they're all gonna rally, right? All the major JNE stocks are gonna rally. They're all way oversold. I mean, how much are they down? Like, let's see, some crazy number. 65%. And some of these stocks down 65%. They're, so obviously any positive news they're gonna rally. But again, is this the end of the bear market? If I have to guess, probably not. Probably not. 76% down. But it is constructive. Looks like this downtrend in these stocks is broken. Right. So we'll see. I would, week 1 above, week 2 above, more room to the upside. I mean, can get to 140, 160. It's possible. Yes, we do have elite offer on lifetime. Lifetime elite offer. What is it? Tradespoon. You know what? I don't know. Let's see. Lifetime. Elite. Do me a favor, we do have an offer. Just open up a chat and just ask one of our product specialists, and they'll give you the link to the lifetime. Thank you. New says the one thing to do just the opposite, Jerry. Also, right, self-serving bias, right? When the market when Alibaba goes up, you're gonna bring, what do you do on a news channel? You're gonna bring specialists that will explain you why Alibaba is up, right? And so it's kind of a hindsight bias, right? Obviously, they're going to say why it's going up. As soon as Alibaba going to go down, they're going to bring a specialist to explain you why Alibaba is down, right? This is all hindsight bias because you're not going to bring a specialist right now to explain why Alibaba is down 70%, right? Nobody wants to hear this. And then but so you get into this trade, especially they're not going to do it right away. They're going to do it when it's at 160, 180. Then you're going to buy at 160 and 180 only to see it go down. So that's the problem. Was news is kind of a post-mortem analysis, right? It's not forward-looking indication when you listen to most of the news. So that's one of the concerns, right? It's kind of a herd mentality. Usually you're at the end of the line, right? Only like this AMC trade, right? Why is AMC was so successful, right? The Wall Street mavens. It was very successful because whoever was in the front of the lines, that they made a lot of money, right? Or Bitcoin. But average retail investors, they're usually at the end of the line, so they start buying here only to see it, drop back to the neckline, right? So you have to figure out where are you in line, right? When you hear the news, right? If you look at Alibaba and it just broke that downtrend, right? For week one, maybe you get into this trade, or you wait till next week, see if there is a continuation. Maybe you get in this trade. But once Alibaba is at 180 and you listen to the news, then you have to say, is this trend broken? Will it get above 200-day moving average and 50-day moving average? Most likely not. But you will hear a lot of people say, well, it's a resume of the bull market in Chinese stocks, and they'll give you an explanation why you should own it. Thanks, Albert. Thank you, Terada. Thank you, Jerry. Thank you. Yes, advisors will never give you an advice to sell. That's true. William, thank you very much for your kind words. I appreciate this. VIX is going higher. Okay, people are hedging for tomorrow, I assume. Let's see, VIX is high, right? So you do have these divergences, right? 10-year yield is higher, VIX is higher, technology is flat. I mean, spiders is down, so it makes sense. It makes sense. But you can see technology is outperforming the value, right? VTV is down 1%, and and technology is flat. But people are concerned about yields, right? So the credit market, the treasury market will set the tone for the equity market. So if you want to know what's going to happen with the equity market, we have to pay attention to the treasury market. Jerry, thank you. All right, let's review the positions and see if we want to make any adjustments. All right, one is FCX. Again, very sensitive to interest rates, very sensitive to the dollar, very strong rally, right? Obviously, I'm short-term bullish, next few weeks, few months bullish, but I would review your position size, right? I trimmed at 42.80. I trimmed at 41.75. Still have stock or option positions. I have both. So expect a lot of volatility in the next few days in this name. So position size is important, but for now I'm not making any changes. We just went over the QQQ trade, also going into ECB decision tomorrow, CPI data on Friday. I trimmed the position, right? Bought 305, trimmed at 310, but this is one of my main positions, right? I think technology will outperform the value in the next few weeks. I do have a credit put spread. I sold 280 put. I am hedging it with 260 put, right? Talking about credit put spread on CrowdStrike or QQQ, and still have, you know, QQQ basically different entry point, 305 to 96. SH, this is one position that maybe if you concerned about tomorrow, and especially if you think you don't have any shorts, I would consider at least have some short positions for tomorrow. One way to do it, if you're not comfortable trading options, I would buy SH, inverse ETF and spiders, inverse ETF and spiders. Personally, I think it's, we still have a little bit more room to the upside, but again, going back to push and regret in front of your decision, if you don't have any shorts and the market pulls back, 5%, 3%, which is possible, do you want to, out of your 4 positions, do you want to have at least one short position, right? Especially if you're trading stocks. I would say probably yes. So then I would, out of those 4 positions, one of them could be SH, especially if you're doing robo-investor or profit accelerator services. That's SH. Silver, again, I long silver, but again, tomorrow it could, it could jump to 2150 or it can drop to 1950. So I have a spread, it expires in June. It's a well-defined risk. I know what my risk is, so I'm gonna hold on to this 2025 call spread. Still long spiders, right? If you're not comfortable trading credit put spreads, right, then I would use spiders, and I would again use the dollar cost average, split the position into multiple entries. So far I'm still on spiders, and I did trim XOP, right, oil. I'm a little surprised actually how resilient the oil is, but obviously, Russia-Ukraine war and additional tariffs, and doesn't look like, demand is still high, right? So oil continues to go higher. So I did trim yesterday half of the position. Bought it at 3, trimmed it at 345. On long-term spreads, 15% gain, and then the rest is at $4. And oil is definitely continue to outperform and continue to go higher. All right. Any questions? It's 9:21. Any questions on Discord? Alex. All right. Thank you guys on Discord. Few announcements. Again, YouTube. If you guys have time, if you like to listen to YouTube, I do. Please search for TradeSpoon. We have 599 subscribers. If somebody can subscribe so we can get to 600, that would be great. But again, you get every day, you're gonna get a video. It's a free content. You get, if you click on subscribe, you get notification on your iPhone or Android device that new video has been posted. We have roundtable highlights with current market conditions every Thursday and Tuesday. We have live trading room. So even if you're not a paid subscriber, on Wednesday you can watch it for free. I believe in education. I believe that you cannot be a successful trader without proper education. Trading is a skill, just like any other skill. In order to acquire it, you have to invest into education. You can do it through the YouTube channel. You can encourage you, if you do like the content, please share it with your friends and family, or if you're part of any forum, traders on Facebook, or I don't know, on Discord, take the link and just share it with your traders community if you like the content of the video. Also the Trader, we actually had few people that took advantage of this offer. Again, if you're trading options, this is a broker dealer in Chicago. You know, we do have a marketing relationship with them, full disclosure, but you know, depending on how much you trade, you still pay commissions for contract. Some people pay 50 cents a contract, some people pay $1 a contract. Here it's $10 a month. So if you're trading, you know, even you know, 2, 3, 4 contracts a week, right, or 5 contracts a week, you know, it adds up, right? And it shows you that, you know, you can sign up for an Expower trader, get savings, and depending on how many contracts you trade, with the assumption, it could be $500 a year, it could be 2,000. I mean, it could be a lot. Depends just how much you're trading. So Yellow Tunnel LP traded offer. I do see some people taking advantage of this offer, so I'm going to promote this again to everybody. You know, if you're trading options and you're trading every week, you're still spending a lot of money, a lot less than you used to, but still a lot of money on the commissions. So consider tradier.com, and that's the link I posted. All right, that's all I have for today. Thank you very much and have a great day. I will see you where I'm going to see you closing. Oh no, Scott will do closing bell today. Closing bell today, and I will see you tomorrow morning. Or we have strategy roundtable. If you like my discussion about Ulysses, we're going to continue this discussion on tomorrow on Yellow Tunnel platform. You can go to yellowtunnel.com and register for the webinar. Thank you very much and have a great day.